Hi everyone, welcome to the weekly stock market update, part of my free campaign for 1 million to teach 1 million people how to be better investors and add 1 million to their portfolios across their lifetimes. And thanks to social media, you can reach those numbers of people as I'm about to show you. Do check out that website for more free resources as well. Let me share my screen. Tell me where you are from. We're going to look at a load of Trump trades as well as what's going on in the markets, whether you should just completely overhaul your portfolio, where the opportunities are, where the risks lie now as well. You should be able to see and hear me clearly as well. One of the most important things that comes out from this update, remember, this is a public one. For those of you on the Great Investments program, you don't need to watch this. You've got a more detailed one on the private channel. Okay, so let's get right into it. Remember, this is not a solicitation to purchase or sell any individual stock. It is for educational purposes and for informational purposes. Now, a new thing that's happened since Trump's inauguration and everything that he has said most recently, and I've been watching it closely, has been that some of these cheaper stocks, this, by the way, is a measure of valuation. You're paying $28 for every future dollar of profit in Microsoft, or $27 for every future dollar of profit in Apple. And you might as well, why don't you just go for the ones in green, which are cheaper? Well, what seems to be happening, and we'll look at those later, and I do happen to own JP Morgan here, and we'll look at Bank of America, which I don't own, but has been doing incredibly well for the whole period in these weekly updates. We've been covering it, which is for the last, a year or more. Is that some of the cheaper ones are now starting to move up. Not all of them, some of them. We'll see if drill baby drill means the energy stocks turn around, and we'll look at some of those specific ones to benefit from Trump shortly. There's two types of Trump trades. There's the high risk speculative, bit like the Trump and Melania crypto coin, and then there's the ones which are undervalued, high growth, dividend yielding companies with good fundamentals, good balance sheets, good cash flows, good profit and loss statements. They're the safer bet. If you want to do the Melania crypto type of stock, and I'll show you some of those, be my guest, go to Vegas, knock yourself out, stay at the Trump hotel there. But there are two types, and the problem's going to be people are not going to know which one's which. How do you differentiate the two? We'll cover that as well. Hi, Anuj, Mansuk, Rajesh, Jan, Carl, Theo, Peter, Scott, everyone from wonderful parts of the world. Hello, everyone. Welcome. Let me know anybody who's, we've got New Zealand in the house. Peter, hello. Anybody else from outside of the UK, do let me know as well. So we're going to return to some of the stocks that I mentioned here. For the moment, what you really need to know is what's coming out in earnings. We're in the middle of earnings season right now, and that's Wednesday, obviously Thursday. I'll tell you when the most important day of the week is. You need to put in your calendar. It's that one, 29th of January, next Wednesday. These are all market moving. After market close, AMC, that's when Microsoft, Meta, and Tesla all announce earnings. That is huge. Okay, that's really going to set the tone. Now, companies this year are going to get really punished if they miss their earnings. Earnings means profits interchangeably. Okay, if they miss, they're going to get punished heftily. So if you don't like the volatility, just look at the charts of any company you invest in, the historic charts. If there's a steep pullback, then historically, then just make sure that those are not the kind of companies you're in, all right? Or dollar cost average in or add to winners. In other words, don't go all in straight away. Add small amounts. If you're risk averse, you wouldn't even get into anything. If you're risk loving, you'd go all in straight away. Most people are in the middle. And they would add to winners, and that's usually a better strategy for them psychologically and financially. It avoids them panicking and making bad mistakes, okay? Don't forget to do all of this. Now, the reason we will more than ever this year need our table of 10,000 equities with companies which are undervalued, ticking the growth box, looking at their P&L, their balance sheets, their cash flow statements, extracting all that data, making sure they're in green for us on that, on cash return on capital invested, on momentum, on high average returns. That's what the Sortino measures, consistent high average returns. So not just a high average return one year and rubbish performance the rest, which is what fund managers often do, but actually consistency of returns, which is what the Sortino does. The reason we're going to need that more than ever is because the market's had two amazing years. In other words, it's going to get more and more volatile. It's going to be that companies that don't keep up with ever increasing expectations, because that's what the stock market does each year. It raises its expectations until eventually the straw that breaks the camel's back, it can no longer see companies meeting those high expectations, and then they fall again. Okay, so that first is you know it's going to happen because you get the turbulence first. Okay, you get the volatility first. You don't normally get sort of an N-shaped move down. Right, so we're going to need to tick all those green boxes. Still doesn't guarantee the future. If you're looking for 100% guarantee, you're in the wrong place. If you're looking for somebody with a time machine, you're in the wrong place. If you're looking for every stock you pick to go up, you're in the wrong place. If you're looking for every stock you pick to immediately go up, you're in the wrong place. Okay, because that's not how the stock market ever works. Don't take my word for it. Look at what Warren Buffett says on these things. Okay, thank you. Rajesh. Good to see you, Raj Agarwal. Thank you. Okay, now, past week, pretty good. Apple, don't worry about this. We're going to come to it a little bit later. I continue holding it, by the way. You know, people are thinking, oh, it's going to fall. Tim Cook was at the inauguration of President Trump. But look at everything else. That's in the past week. I mean, you know, Eli Lilly may well go into our Quality 5 Plus, the plus element of the extra stocks, which characteristically have consistent gains year after year, which are quite large, relatively few down years. We're going to look at that to see if it can qualify into the sort of the Hall of Fame, basically. What that does is they're the core bunch of companies that we can just keep dipping into year after year, with the occasional year where you have to go into cash like 2022, which just keep giving us outsized returns, so we don't have to work too hard. So we're going to see later on if that meets it or not. Okay, the jury's out at the moment. Hi, Bhavesh. Hi, Gary, Rekha as well. Nice to see from different parts of the United Kingdom. But yeah, that's a pretty bloody good week, isn't it? Okay, you've already beaten bank interest in 1 week alone. Just take your profits, go home now. Over the past year, over the last 12 months. Now, this is where it gets a little bit interesting. Look at the diversity of moves. 146% on NVIDIA, but Microsoft lagging. Now, Microsoft, as one of our Quality 5, has been a consistent, reliable performer. So if it's had a lagging year, we anticipate actually to be more bullish on it. And that's another characteristic of the Quality 5. What happens is if they do tend to lag, they catch up later. You can't do that with every stock, but you can do it with certain ones which match the value, growth, income, cash flow, Sortino, and all the rest of it. So some of these laggards we're quite happy with. Oracle, you saw Larry Ellison was in the White House. I did a note for my private clients on the Great Investments Program just yesterday, just in terms of it needs a more complicated strategy than just, oh, let's just buy. And the reason is because of volatility and because it's overbought and because it's not been a reliable, consistent performer, hasn't Oracle. So whilst they've got the blessing of the president and they're going to extract a lot of benefit out of building data centers for him and investing in data centers, what they're going to say afterwards is, look, the president said we've got to build some data centers and make the investment, but to do that, we want loads of free land, we want free this, we want free that, we want tax breaks here and there. So we're not speculating on narratives. What we're looking at is value, growth, income, cash. In our spreadsheet, everything has to come back to the data. Back to the data. We're not gambling on narratives. There are two types of investors: those who look at the data and take the scientific approach of testing a theory, undervalued stocks, high growth, dividend yielding, cash return, capital invested. That comes from Goldman Sachs Wealth Management. And the speculators, the ones who say, I heard a story and a theory and this looks good. Okay. So that's the past year and how it's been. It's been pretty strong. Exchange traded funds, I will do separately for you. You can take a snapshot and a picture of that. The great thing about exchange traded funds, which I've sort of underrepresented, I think, over the past year or so, is, and particularly in this kind of environment, the drawdowns, the falls from peak to trough tend to be quite shallow. And you can pick the volatilities to be under 10% and still get a really good 20, 30% return if there's a tailwind, okay? So you get less of the downdraft. Now, exchange traded funds, I first wrote about 25 years ago in my Financial Times column. I continue to like them, and I'm going to talk more about them going forward, okay? You've seen with Drill Baby Drill Energy, he's come out of Paris Climate Accords, and he said literally drill baby drill, and that seems to suggest some of the energy plays will be stronger. But we'll keep an eye on that for you. I mean, in the past month alone, look at that, 22% up, and that's a fund. It's a basket of stocks. Okay, so that'll come later. Now we know the market. This is the US stock market. That's the price you're paying. You're paying $32 for every dollar of profit when you buy an American stock. You're paying $32 for every dollar of profit those stocks make. That's historically expensive because you're paying 32 before you were paying, I don't know, 18 or something. We know it's expensive. As long as profits keep rising, okay, and sales keep rising, we should be okay. Overall, I don't see anything in terms of the policies he's making to make that go away. The biggest determinant, I think, of it's a formula John Maynard Keynes, the economist, the British economist, came up with about 100 years ago of the economy, and he said, you know, GDP growth is dependent upon this factor, this factor, this factor, this factor, and then he put an X factor in. Okay, well before Simon Cowell put an X factor in, and the X factor was animal spirits. And if you look at Elon Musk jumping around, that X factor of business confidence is huge. Now, what that means is America's dashing for growth. Okay, they're going to have lower corporation tax. They've said that already. He's going to try and pressure interest rates to fall from the independent Fed. He's made that clear as well, and they're going to deregulate like crazy. They made that very, very, very clear. If that's the case and they're going for growth, then Europe, the UK, well, the EU, Europe has to catch up and do something. Otherwise, it sucks the oxygen out and they get all the growth. And where they're going, well, where do we raise taxes? How do we cut spending? So I suspect some policies in Europe will change, and they too will try and target lower interest rates sooner, more deregulation sooner. I don't know how the EU is going to do that. They've got a lot of socialist governments in there, and it's against their just the mindset. They would rather sacrifice growth and have more. They're more like a lifestyle business than one which wants to make billions. Let's put it that way. Okay, so I think the Americans are going to be accelerating ahead even more so from what I can read on the narrative. I'll go by the data, not my narrative. I'll go by the data. Okay, this is for your own viewing. I don't care about particular sectors. I mean, I can have a conversation as to why consumer discretionary should do better, etc. These are the forecasted growth, but those are how expensive they are. So if it's expensive, it counts against growth. What you really want is something which is cheap and growing. That's why I like to look at the companies and not the overall sectors. And when we look at the companies, we look at these things and their cash flow and their growth. This is at the sector level. It's just for information, nothing for you to do with it. Now, over the past 7 days in the US market, which have been the top winners, Amazon, Nvidia, Alphabet, Microsoft, I own all of those. Okay, which if you've been watching my broadcast, you know, not taking anything away from the Great Investments Program, but my students will know that's some things that are in the public domain. This is in the public domain that I own all of those. Okay, now price to earnings on the UK market. This is the UK market. You're only paying £20 for every pound of profit UK companies make. The problem we've got in the UK is, and the stock market's at an all-time high, which worries me, when you've got falling profits and falling sales. That doesn't mean it's going to crash. It doesn't mean that at all. Okay, but it does mean what I said previously when I come to it, which is if the pound falls against the stronger US dollar, then a lot of earnings for UK companies are in US dollars because it's our largest trading partner and the nature of the companies. And therefore, when the accountants turn those dollars back into pounds for bookkeeping, it looks like these companies are suddenly cheaper. Okay, so it's almost a technical rise and a bump that we've got in the FTSE rather than a full-blown confidence in the broader market. But what do we care? As long as we can buy low and sell high, I don't care why the market does what it does. I don't even care if it does it incorrectly or I think it's wrongly. It's not my opinion that matters. What matters is making money. Those are the figures that I simply said, but for the UK, okay, and these are the biggest rises over the last 7 days. Okay, a lot of the banks are expected to do well because interest rates are going to stay higher for longer, and maybe there'll be more transactions with Trump in the White House that some of these banks, I mean, obviously Lloyd's is not on the investment banking side, but it's only Barclays and HSBC will be looking at some of the benefits on that. Maybe that's the reason. When I used to do my Bloomberg TV show, we'd look at this would go on screen, and then we'd ex post facto come up with theories as to why. Well, it doesn't really matter. The market does what it does. We just want to be in a position to profit from it. I'm not going to talk UK market so much on this one. Exchange traded funds, I do want to talk a bit about at the moment. If you look at performance year to date, you've got this performance over the past month. Okay. And you can see some of the energy companies, robotics. This is not a recommendation for any of these. It would need more of a drill down by me in order to do that. But you can certainly see, for those who might not be aware, there are natural gas, exchange traded funds and so on. But what I look for with exchange traded funds is momentum over 1 month, 3 months, 6 months. That's the first thing. I look for high average returns, which are consistently high. I look for a high Sortino. That's what that does. And I want volatility, preferably, I guess, below 10, 15%. And that ensures that I've got low downside, higher upside. The narrative I'm less concerned about. Okay, the stories about, well, because of this, you know, like gold or whatever else. People are asking me, because I told them my wife bought some gold, what exchange traded fund did she use? No, she bought physical coins. Okay. Now, markets year to date. Year to date's barely in, but it's looking looking good, obviously, so far. These are the sectors which have been running ahead. As I said, I don't gamble on sectors. I look at individual companies and do the drilling upwards. Energy has been doing incredibly well, of course, and industrials, well, there's a whole view that infrastructure should do well because he wants to do a national renewal and get private sector to start building in America. So you would expect that to do well as well, and materials as a result of that, because you need materials for that as well. Okay, but again, I care about the individual companies, and we'll come to that. This is just setting the scene a bit. And momentum, it is very much a momentum-based market. Okay, why? Well, because we know valuations are expensive, so it's difficult to find justifications based on valuation. So you end up on momentum. Let me tell you what I mean about that and why that's important for us. When we're looking at individual stocks, we look for ones which have momentum, we look for ones which have growth, and then we look for a subset of those which have dividend yields, and then a subset of those which have volatility. And of course, within that, we're looking at Sortino Alpha, Croaky, and certain other secret sauce recipes, you know, like Mama's secret sauce. Okay, all within there, all within there. Now, that means if momentum is the leading factor, it doesn't matter, because our stocks will have that. If it means value is, or low volatility is, or momentum, or value, or growth is, it doesn't matter, because it will all have been in that subset. Do you see? We're not just trying to pick a few names that the man at the pub or a journalist told us about. We're trying to go from 10,000 down to 200, and then out of the 200, pick the best 20 to 40 to suit our risk appetite based upon volatility. If you're risk averse, volatility under 10%. If you're more risk neutral, under 20%. And if you don't care because you're risk loving, then volatility doesn't matter at all to you anyway. Over the past year, it's been 25%. Now, what I should have done is last January, just done a video and said, look, I'm doing 3 times leverage, S&P 500, which I'd held from January 2023, and I'll see you in a year. And I would have come back and said, we've made 75%. Okay, sadly, I didn't say or do that. And so we didn't make 75%. I'll come to results in a second. But if all I did was put all the money in the S&P 500 3 times leverage, which I didn't put all of it in, I only put some of it in, then cheerio, and that's all we needed. The thing you've got to know about is this. There are periods when all the gains you make go back to zero. All the gains you make go back to zero. Okay? And then you get periods of growth. In other words, sitting on your hands is what makes money when it comes to investing. Sitting on your hands is what makes money. People find that hard to do. What they do is they get out prematurely, they give up hope and get out belatedly, time and again. Who made the money? The one who sat on his hands. Now, of course, theoretically, what they're also trying to chase is, what if I can get in here, get out there, get in here, get out there? Well, that's trading, and that's fine, but this webinar is not about trading. My background, when I set up the hedge fund, is trading based, but this isn't about trading. This is about investing. And investing is about sitting on your hands for a longer period of time, like 12 months. FTSE top 10, FTSE 350, okay, price percentage month ago. 32% on Ithaca Energy and so on. We don't know. This is not a UK market one, but just letting you know that's what's moved. That's a hedge fund, an American hedge fund, which is listed over here. So let's go into what this webinar is more about. The S&P 500. Now, as you know, I've been saying it since January 2023, so I'll say it again. I own the tracker, I own the 3 times leverage, I continue holding it. If you're risk loving, you would buy into it because you're risk loving, you'd buy into anything, even if it's overbought, which this is. If you're risk averse, you wouldn't because you'd never buy into something overbought. And if you're risk neutral, you'd add to your winners or dollar cost average. Really simple. Okay, you're one of those 3 categories. So where are we on this? Well, it's like it was here. So has it got room to go? Potentially. Is it going to keep doing this? Potentially. It could keep doing that. After Trump, is it going to? Potentially. All I've got to decide today is, do I sell what I hold? No. Would I buy more? Only if I'm risk loving. If I'm risk neutral, I'd buy a little and then edge in and buy more as I become more profitable in it. And if I'm risk averse, I wouldn't do it because it's overbought. Simple. Okay. That's the daily. This is the daily chart, what it looks like. What's going to happen in the short term? Well, that should move up and turn this up a bit before possibly pulling back. So we should see potentially this week an all-time high on the S&P 500 as well. Mark, I know, FOMO emotions. If you can manage your emotions, you can make millions in the markets. Nasdaq 100, similarly to the S&P, bit more room to go. Okay, before we get at some point, I don't know whether it's going to be this year or next, we get more of a pullback. Look, 3 things the market can do: go up, go sideways, or go down. All right. Now at the moment, it still seems like we're going up. What do I do with my Nasdaq 3 times leverage right now? What do I do? Well, I don't have to exit, so nothing to do. That's it. I'll wait till the next broadcast. I often say this to you. I say, well, nothing to do. I'll wait till the next broadcast. This was last year's performance from my broadcast last January, okay, which we did based upon the approved list. Then we filter it. Okay, so the January, I think it was the first broadcast of the year. It was January 11th. Paresh tells me, and he went through it and he said, right, those are your results off it. I still own Goldman Sachs, MicroStrategy. So this is from that broadcast. I don't necessarily buy everything because I can't buy everything from every broadcast. If I look at February's one, March, and April, but I'll tell you what I still own: Nvidia, the 3 times leverage, Meta. And this doesn't mean you should buy it today, because if you're risk loving, you would. If you're risk averse, you wouldn't. And I'll tell you what will happen with most people who think they're risk loving and they never are, is the moment you get a 5% drop and you're down 15% in a week, they'll exit and they'll lose the money, and then it'll shoot up and they'll never have got back on, and they just had a jolly trip where they saw other people making money and they couldn't take the volatility. So if you can't take the volatility, that's why volatility is so important. You will mess up even in a rising market, even in one which goes up. The number of people who will just mess up and watch other people make money, even though they made the right decision to get in initially. That's why you've got to get it aligned to your capabilities. That's why I don't have all my money in S&P 500 3 times leverage, because if I did for the next 2 years, and you can put it in your diaries, I probably make 50-60% return at least, okay, over the next 2 years. But I do not have the guts to just do that because of the volatility in between. And if all my investment wealth was in just that alone, okay, I would be scared myself. And it's the reason Warren Buffett, he said he's a long-term believer in the American market. Why doesn't he have 3 times leverage on the S&P then? Since forever he would have outperformed what he's ever done, because even he doesn't have the guts to just put all his money into one thing. Okay, I never bought Ambia, right, even though it was on the list, because I can't buy everything. Okay, can't buy everything. So I never bought that. I continue, as I said, holding that and that. All right. So yeah, 41.52. Am I happy? Am I sad? Well, a little bit sad, because the year before it was closer to 80%, and you can see that on the website. The year before that was 0%, because the market in 2022 had fallen, and we had to hold cash most of the year. So you went from 0 to 80 to 41. Well, that's not me. It's not because we're clever or anything else. It's because those companies are clever. And there were 29 stocks. 5 hit their stop losses of 25% drops from entry. Okay, so out of 29, 5, nearly 1 in 5. So what, 1 in 6 roughly hit their stop losses, which is unusual in a year which was so positive. So what I'm saying to you, you're going to get that kind of volatility even so this year. These were the best performers from that list. And as a result of which, we had lots of, if you'd like to leave a testimonial, I would love it. You can leave it there, testimonial.to/alpeshpatel. We had some very nice ones from a bunch of, these are just some of them. There's a whole load more from that. Some are old, some are very, very new. Okay, FTSE 100 all-time highs apparently, but the all-time highs in the FTSE 100 means that you're closer to 2019. Okay, so what? And I said it might bounce off its moving average, and it has, because it often does. Sometimes it doesn't. It does that. Sometimes, where was it? I think we had a recent example. What does that mean for us? Well, it might just, well, we'll keep an eye on it. It might trudge ahead. Okay, it's the FTSE 100. S&P 500 2 times leverage. Now, I belatedly bought that in, I think it was November or December of last year, because until then I had the 3 times and the 1 time. So why did I buy the 2 times? Well, in case I got other 3 times, just because I was worried, what if the market drops? And I still want some leverage, but maybe not as much as 3. So I did this, and also to showcase it to people. Sometimes I buy stuff to showcase to people during the course of the year, and it's going along nicely. Now, you don't do leverage unless you're risk loving. If you're not risk loving, don't do leverage. In fact, none of you on this webinar should do leverage, because it'd be irresponsible for me to suggest it. Top 10 S&P 500 stocks over the past month are these. We're going to look at some of these, and a lot of these are Trump trades. So let's have a look in detail and see how they look. Well, some of the energy ones, that's how it is. Now, on the Great Investments Program, I'll go through whether or not these meet our filters. I've not had a chance to do it, so don't read this as my recommendations. Okay, on the Great Investments Program, I'll go through whether it meets our value, growth, income, cash flow, Sortino, alpha. But as you can see, and that projection is if it were to continue. So this is not a Great Investments Program recommendation. None of these are, because we've not had a detailed look to see if they meet not just our criteria on 7, 8, 9, or 10, but also on momentum and on other factors as well. Vistra Energy was one of our picks from a while back anyway. EQT, okay, is one of the big performers, and these are some of the ones which are benefiting straight off of Trump. Look at that. Look at the volatility on that. If you can handle that kind of volatility, good luck to you. Okay, it is scary. See, a lot of people will get in thinking, oh yeah, I'll get that, and because it'll go up in a straight smooth line. No, it won't. It'll give you heart attacks and drop like that. Prolonged periods, drawdown danger, that depth and that duration. So don't just, oh, Alpesh, I saw a webinar and you mentioned Corvo, so I thought I'd get in. Now it's down 40%. You'd be nuts, okay? Unless you really like volatility. Energy, smoother, but look, there's a drawdown. Always want to look at historic drawdowns and the duration before they recovered and the depth of how much they fell. All right, and they're overbought like so many stocks as well. That's why on the Great Investments Program, we're getting fewer stocks this time than last year, just so you know. We're having to be pickier. We're having to narrow down. We're having to look also at exchange-traded funds, because that opens up another 7,000 securities on top of the 10,000 that you've got in the stocks. So we need 17,000 when the market's this overbought, so we can still get our 20 to 40 instruments that we want to hold as well. I'm not holding MicroStrategy, no, Bhavish. I've got crypto directly. So I've got Ripple, I've got Bitcoin. Nothing ingenious about that in my holdings, just so you know. Ripple I had for the last 8 years, and it's been down for 7 years and 9 months until Trump became president, and then suddenly in the last 3 months of those 6 or 7 years, I think it's 6 or 7 years, however long it was that I was negative, I suddenly looked clever. Okay, so Ripple, Solana, which is more recent purchase, Bitcoin, and Ethereum, which again, the Ethereum has barely bloody done anything in the last 6 years. And Bitcoin was the one I put the least in, just so you know. And I only did it for fun, okay? No serious money. The traditional only money I could afford to lose, all right? So don't come to me for crypto. It's like asking me which modern artist do you like, Alpesh, okay? Or which property do you like? All I'll say to you is, yeah, hold it for 10, 20 years. You should be fine. Or not. I don't know. So that's where we are with energy, okay? On that overbought. We're going to look through these on the Great Investments Program because they need to be filtered. This has just been sent to me by my graphics team. So we have a data team who pulls out all the data from the market. Graphics puts it all together, but we need to do the analysis yet. So don't just think that these are all approved, as it were. Katera Energy, again, you see a lot of the energy ones, but it really needs to break through that, and you can see they've been going sideways for a while, and they're incredibly volatile. I don't like volatility because I've got alternative choices. I've got smoother movers, okay, are far better. But it's overbought. So be careful. I've got to repeat again, just because it's a 7, when it's overbought, you can easily be down to there. And it goes back. So don't get carried away. We've been covering this for ages, and it's had another great bloody month. Okay, so that since the start of the year, it's up again. A GE spin out. This can't be on the Great Investment Program under the normal rules, simply because there's not enough data. It only IPO'd recently. GE spins out more of its companies, and they seem to do really well, because this has gone up threefold in the space of a year. I think they'll spin more out anyway. The point is, the reason I'm talking about it is because it was here. It's on this list. Remember, each week when we do the broadcast, we talk about the biggest movers. So it's just a statement of just showing you what things are and what they're looking at. Now, going back to normal service, Bank of America, it's an 8. I've been covering it. I don't own it. Remember, I always talk about stocks that I own and don't own, because it's this weekly market update. I don't own it. I haven't owned it for the last, how long I've been covering this? 18 months. Okay, I haven't owned it during that whole period because I can't buy everything. And I've been covering it to show you what's in the market, just to give you a flavor of the financial sector, really. And indeed, it has been rising. Now, obviously, in hindsight, Alpesh, why did you not buy it? Well, because there were others which did just as well, if not better. But there you go. That's where it is. I'm not saying that projection is going to happen. It's the same broadcast I've given before, which is, and week to week, there's nothing that changes. It still seems like it's got legs to move up. Netflix had bumper figures yesterday. And again, one I don't own, just so you know, but I've been covering since that period when I started doing the weekly updates. And what's that? Since August 2023. And I've not owned it, and I keep saying it, and I've had sometimes people saying on TikTok, you didn't buy it, why didn't you? Well, yeah, in hindsight, I wish I had, but I covered it because I wanted to show people how this momentum thing works. And you've had a weekly tutorial, sometimes twice a week, on me talking about it, and you can look on YouTube at all the old videos and going back to that period and saying, oh, bloody hell, he really did keep saying that, didn't he? So there you are on it, and it still looks like it's got some legs. It is overbought. And we'll have pullbacks in between. Okay. That's my wife at number 10 yesterday, making plans for London Tech Week. So again, technology companies that we're trying to pull into the UK from around the world. I'll discuss more of what I can on that going forward. We really need to boost data centers. I don't think there's any secret to that. The Americans have got to jump on us. They've got about 1,000 times more data centers than we have, and we really need to do something about microchip production in the UK. I'm not releasing any secrets to you when I say those two things, and that's what the plan is, amongst other things. Once a bull market goes to 2 years old, there could be a lot left. That's the research out of FactSet, looking at historic bull markets from 1974, 87, 09, 82, 02, 22. Okay, historically, they've tended to do better. This is where we are. Okay, we're just here. We're just there. Could this have longer to go? Well, yeah, but then again, history is not a guarantee of the future. History is not a guarantee of the future. Alistair, I've discussed how I consider things overbought. I'll just give you a quick analysis. I've done it on various videos, but I'll just show you. So we look at the moving average, which is an average of the recent prices, short and medium term. And if, when you're looking at this window, if it's in the top quarter to a third, that tends to be overbought, and oftentimes you get a pullback, as you can see there. And if it's oversold in this bit, oftentimes you get a move up. It's not guaranteed to work. If it was, I'd be done for witchcraft, but it tends to work rather well as a good indication of many things to watch. A bit like weather forecaster looking at the sky. Okay, can be a pretty good thing, but it's not perfect. Just watch out for all of these poor performers. They're going to be even worse this year, and the reason they're going to be worse, missing their benchmark. For benchmark, read exchange traded funds, passive exchange traded funds. The reason they're going to be worse is because they spray and pray, and because they put little bits of money into so many companies, and the likelihood is, yet again, we'll get a concentration of outstanding companies, survival of the fittest, doing well, they'll underperform. Okay, why do they put spray and pray, so much money in so many companies? A, because they have so much money, because they're really good at marketing. You've heard of all of them, haven't you? That's how you know they're good at marketing. All right. When they're good at marketing, they get so much capital, they can't put it into just a few companies. They'll take those companies over if they did that. So they have to spray and pray, which necessarily institutionally means they are set up to fail. And the proof is here. Eugene Fama got a Nobel Prize in economics in 2016 or 2018 for showing that. Okay. So that's going to get worse. And it's going to get worse because after 2 great years of the markets going up, it's more likely you're going to get more concentration of companies that are survival of the fittest and can meet those ever higher expectations of beating earnings, which means their spray and pray approach is even less likely to work. Their approach tends to lead to less underperformance when there's a broader market move up. This is another version. The names to watch out for if you've got any of these. It's not the fund alone which is the problem, say SJP Global Quality Fund, which is down 27% against its benchmark. That's not necessarily the problem. The problem is actually the issuer. So who's the company producing these funds? Because it's not just that single fund, which might be particularly bad. It'll be a whole bunch of their funds because they're using the same methodology. It's a bit like saying Volkswagen. It wasn't that the Beetle was bad and had wrong diesel emissions. It was just every single Volkswagen was bad because every model, because of how it was engineered. And they're engineered to spray and pray. Unless there's a broad rally, they can't beat the index when it's a concentrated rise, okay? Or when it's a broad rally which is based upon rotation, so you just constantly keep moving from one group to another group to another group, and you just can't keep up. So it's another time when they fell. Anyway, poverty gap between UK and US pensioners. The problem with the UK pension industry, one of many, is that the wealth managers, IFAs, insist on buying. Look, you live here in the UK and they insist on giving you more exposure to where you live and not giving you diversification. In other words, they'll keep shoving you into UK entities. Okay, they might give you some Japan and emerging markets, but overall they'll give you, and by the way, emerging markets, what a stinker for last 5 years at least. So what ends up happening is you're overexposed to an economy in which you already live and have immense exposure. They should be diversifying by saying, we'll give you nothing in the UK because you already bloody live here. Your salary is dependent upon it. Your cost of living is dependent upon it. Everything, your house is dependent upon the UK. Let's give you proper diversification. So when they talk about diversification, they're lying to you. And the way you know, well, their lips move. The way you know is because they keep shoving you a load of UK stuff. All right, because they get fees from it. They get fatter fees from UK stuff than the overseas stuff, because the overseas stuff, there's other intermediaries to pay. Anyway, they might claim, oh, no, we don't do that. Don't you know what we do? No, we advise them on the best bank account as well. Yeah, well, sorry, that doesn't make up for the poor service elsewhere. That gap between not just the Nasdaq or the S&P and the UK, that's the UK down there, that's going to get wider over the next year, over the next 2 years. And again, just look at who was at the White House alongside Trump, and just look at who's at number 10 or number 11 with the Chancellor. Okay, with the Chancellor, it's people who are asking, how do we raise interest rates and remove assets from pensioners and farmers, those who've got assets, and give them to unproductive people with less assets in the hope that they might suddenly turn more productive because it's just a fair thing to do, which is great if you want justice. But if you want growth, I'm afraid they don't always work together. All right. Unfortunately, it's just one of those unfortunate things, right? If I want growth, my family moves to the UK from India in 1968. If I want justice, they say, we're never going to speak to British people ever again. Take your pick. Which do you want? Most people will go for growth over principles of justice and moral outrage, right? So we're going for, well, that gap is going to get worse. When I get positive comments like this, which I love, I've managed to grow my portfolio from approximately 65% over 2 years with the help of the program. It's not actually the program. It is the fact that he joined, selected from the data, followed what we taught him, and the markets had a tailwind and companies did incredibly well. Okay, so I can't, in a way, I shouldn't be, I'm not trying to be overly humble about it, but what I'm trying to say is I ride the coattails of these big corporate companies. I'm not Elon Musk. I wasn't in the White House. I ride their coattails because it seems a bloody clever thing to do while sitting here in my warm house. Okay. Has your pension lost a fifth of its value this year? We revealed the lottery of returns on work and retirement plans. This is, you're going to see a lot more of. This was from This Is Money a while back. Okay, so just keep an eye out for some of these stories. Fifth of its value. I'm not saying that. I'm not trying to, somebody said, oh, people, you're going to scare people. It's not me scaring people. It's scandal after bloody scandal. Now, we've had the post office scandal. We've had the phone hacking scandal. What the hell's going wrong with our country? Okay, we've had the pedophile ring scandals. Okay, what are the scandals? I don't know, right? We've had scandals we're not allowed to talk about. So many scandals. This will be the next one. It's already there. It's in plain view. And do you know what's going to happen 10 years from now? Somebody's going, well, the Guardian and the Mail and the Telegraph were the first to report upon it, and nobody did anything for 10 years. Well, until they make a story about it. To the extent, even the Financial Times, every single paper recognizes it. Daily Mail, Financial Times, give workers power to ditch pension schemes. Okay, reform to workplace pensions because they're getting piss poor returns. Why do these retiring face massive losses by FTSE highs? We're now at FTSE highs again. That's the Guardian. Hardly the FT, is it? It's hardly the Daily Mail reader. Okay, everybody from left to right. It's like the post office scandal. It's going to break sooner or later, and you're going to say, "Shit, Alpesh, you were right to point it out. I didn't do anything. I'm just repeating what even they've pointed out." The Telegraph, our British fund managers become pointless expense for investors. All right, worse fund managers take $500 million fees from investors. Made my job even easier pointing this out to people. 20 years ago, when I first started writing in the Financial Times, I've had 200 columns in my weekly column in there, published since 1999. Okay, I didn't point this stuff out. All I point out is that fund managers are piss poor and they underperform. But I didn't keep pointing out this like the newspapers do because I can't write the same column every single week. Okay, Paresh joined in 2021, 60%, 15 months. Right? Great. But that's because he did a little bit of work. He got the Excel sheet and did it. It's going to require a bit more effort. Now, if you don't want to do the effort, that's simple. Give it to St. James's Place and you'll get a lower return or do bank interest. And that's a choice. That's a fine choice because I can say to you, I don't want a six-pack, so I'm not going to go to the gym 5 times a week. One day, hopefully, I'll wake up and say, screw it, I'd really want that six-pack. This is not new. This is not new, what I'm saying to you. New is that I'm saying it on TikTok and YouTube and webinars. That technology didn't exist. That's me. It's one of my earlier columns, okay? I've been saying it for 25 years, right? This is my son's junior ISA. These aren't the ones he holds at the moment. We'll come back to Globe, and I'm sure sometime in the future, I'm not sure we'll come back to Premier Oil. He still owns Amazon and Apple, and he now has the leverage positions in them. This is an old screenshot, okay? The reason I say this is my son's junior ISA has fewer stocks in it, just so you know, because people sometimes ask, what's in your son's? He's 6 at the moment. He's about to turn 7 this year, right, next month. Now, he has fewer. He has leverage. That's where I take the risk, but in a Microsoft, in an Apple, in an Amazon, not AIM stocks. People say, oh, should you take more risk in your son because he's young? Yeah, but measured, calculated risk, right? And that gives us some edge. You might say, well, that's not fair. You know, how your son's, it's unfair your son gets such an advantage. I'm sure they will tax the crap out of him because of who his father is. Okay, start with 100K in 2021. He's now got to 400,000. Yes, he added a little bit of cash. This makes me incredibly happy, stuff like this. But I always tell them, I say, look, like a school teacher, saying, yeah, but I'm not going to say hard working because we give you all the data and we show you how to do it. So it's not actually hard work. The hardest work you have to do on the Great Investment Program is sitting on your bloody hands and not sort of staring at it all the time. As I proved to you last year, you know, you could have just done the S&P and got your 25%. What are some of the other lessons I want to take into this year for you? You've really got to check all the boxes, even more so this year, please. Whatever methodology you're using, if you're not looking at companies which are undervalued and growing, then you're flying blind with some income generated through dividend yields preferably. There are exceptions to that, but if you want to do meme stocks, always work out, is this speculation, which means lack of information and guesswork, or does it take value, growth, income, cash return on capital invested, or some other cash flow measure? Just have some measure. Average consistent returns, you could look at that on a chart on Yahoo Finance or TradingView. I.e., you don't get the ratio, you just look at the chart. Is it tends to go like this, or does it go like this and up and down? Okay. If you don't do that work, you're speculating, and you don't want to be a speculator. This is something from Goldman Sachs Asset Management. Okay. Basically, and most people think this is conservative. 25 years to retirement, how much should you have in equities? I think you can have up to 90% in equities. Now, personally, I don't know, maybe I've got 5 years, maybe I've got 0 years. I'm still here. and I'm going to plan to be there. Fixed income, 4.5% in the bank at the moment, probably the easiest way to get it because the banks put it in bonds for you. And then you could put some exchange traded funds under 10%. If you're risk averse, less than 10% volatility. If you're risk neutral, under 20%. If you're risk loving, doesn't matter what you have. Okay. Okay, I'm going to go through this as well. Yash, can you give us a stock for those? Yeah, I gave a load. I'll go through them again in just a second. There were low. How many have I mentioned on here? Okay, portfolio risk. But I know what you. I know what you mean. What you mean is yes, but you didn't say you'd do it. So let me sort of do that in a second. This, you need to be out of the market to avoid market risk in years like 2022. Part of my job is to be the lighthouse watchman. Okay, 20 to 40 stocks. If you're risk averse, you'll be closer to 40. If you're more risk loving, you'll be closer to 20. All right, simple as that. And that's how you work it out. Okay, by the way, everything that I told you is in all of my books. I'm not expecting you to read them. That's why webinars are a lot easier. And that's why I don't just say to people, here's an online material, go read it. But you can download those. In fact, I'm going to make sure we give you some of those, give you one of those books now in case you've not already got it. Right, you should be able to get Investing Unplugged already. That was Barclays kindly did a book launch for me. Also on here, I'm going to answer questions in a second. Also on here, you can schedule calls, you can get copies of the book, you can see the latest webinar, including this one later on, and you can see other books, especially if you're into trading and you want to see the MACD, you can download that for free. That's free, okay? Trading online is what you want for that one. I also, and increasingly this year, I think it's going to be important, I'm going to cross-reference whatever's on my filters with what some of the more consistently profitable hedge funds will be doing. So I look for ones which have been up 40% at least over the last 3 years. 40% at least. This one's 53% per annum for the last 3 years. Okay, and then we look at what are they holding. In fact, what we do is cross-reference. This is an old one, so don't follow this one. We look at what stocks overall in aggregate those hedge funds are holding, and these are all the hedge funds that we'll look at and see if any of those are then in our filtered list for value, growth, income, cash flow, Sortino. And that'll be even more important this year because the third year of a big bull market should be more volatile. What I'm trying to do is be down here. How quickly can we double our money? The closer I am down here, i.e. if we're getting 20% per annum, then you can do it in 3.8 years. What we're trying to get away from is your sort of average St. James's Place who can do it in about 20 years. They'll double your money in maybe 17, 18 years. Okay, we want to try and be down here. Now, quite frankly, at which point am I happy? I'm happy if it's 5 years. I don't care whether it's 5 years or 3.8 years. Really don't. Okay. What I don't want it to be is at this end, right? And the way we avoid it is, well, first of all, the S&P gives me this. If I double leverage the S&P, then I'm already here. All right, simple as that, right? My job is not to mess it up. You might say, why don't you just get the S&P and just bugger off? Yeah, I could and should. And we'll talk this time next year. You go, Alpesh, you did a load of webinars. You wasted so much time because what you said in your first webinar of the year was what you should have done all year long. And you can mark that down, okay? And I'll give you another, Microsoft. I've got 2 times average Microsoft. Just hold that and 3 times on the S&P for 2 years and I'm fine, okay? And I don't need to do any of this. I'm going to call it. I'll get 32% over the next 2 years, okay? Because why? I'm cheating because that's what the S&P gives me anyway. And I think I'll at least match the index. I should do better, shouldn't I? Of course I should. But I don't. My grandmother taught me a very important thing. Never count money until it's in your bank account, okay? And always count all your expenses, but never all your income. Because then you get a nice upside surprise. So I should do better, but I can't imagine I'll do much worse than just the index, not least because a lot of the index is in my investments anyway. It's pretty bloody simple, people. When you overcomplicate it, you lose money. 12 months in a 30% increase in portfolio tailwinds. When there's a tailwind, we'll do better. When there's a headwind, we won't. And we're just liberating people to be able to do this for themselves. I started writing those books, those Financial Times columns, so people could make full use of their ISAs and SIPPs. ISAs and SIPPs were created by the government for you to make your own investment decisions. Instead, what people do is say, no, I'll go and give it to St. James's Place and give it to these fund managers and let them send their kids to private school. Okay. And then they wonder why all those headlines in the newspaper are there, that they're getting poor performance. If you want to see videos of clients and case studies, it's over there. Okay, I really believe anyone can do it. That's why Barclays, not an advert, I'm not affiliated to them, and all the other brokers offer SIPs. Why the government offers self-invested personal pensions, because they know how bad the pension people are. Okay, and a classic example being this: 50%, because people buy, I've written a column about this based on academic literature, people buy name recognition funds. I'll tell you what they do. Two big mistakes people make, and don't take my word for it, the academic literature proves this. Two big mistakes they make. One, they go after last year's winning fund. The data shows last year's winner will revert to mean and not be so good this year. Therefore, it was last year's winner by more by chance than luck. Eugene Famer, Nobel Prize in Economics. That's the first thing. They go for last year's winner because last year's winner is the one that advertises the most, which leads to my second big mistake people make. They go for name recognition. So they go for Fundsmith. For the last 4 years, Fundsmith has underperformed the market. And guess how much Terry Smith paid himself last year? £28 million. You people, you pay for him to keep underperforming. Now, if I was him, I'd take your money. I'd take your 28 million and keep underperforming year after year after year and say, no, don't worry, this is going to be the year, because nobody's going to say no to 28 million. All right. People will buy the name recognition fund, even if it's rubbish. And it's not your fault. You do it because it's the only names you've heard of. That's why we give people 10 in the on the spreadsheet, 10,000 stocks, 7,000 funds, and then narrow those down into the best of the best. By the way, last year wasn't a one-hit wonder. 2020, 21, that was that much, and these were some of the winners. By the way, as I famously said time and again, I didn't buy that from our list. I didn't buy Crocs. Ravi bought that, one of my students, and he did better that year than I did. He got more that year than I did because he bought stuff that I didn't buy. This was last year, 2022, in case you're wondering. Why have you left that out? Zero, because we had to hold cash because the market was falling. We didn't know it was going to fall that year. It's just that we couldn't find anything good. And so we waited till February and then waited till March and waited till April. Did I know NVIDIA was going to go up 238%? No, because I would have put all my bloody money in there. You could look at this and say, Alpesh, you idiot. Why'd you buy all those other companies when you could have just bought that? How come you only got that when you could have had that? Yeah, because we don't just buy one company ever, because we don't have those kind of kahunas. Okay. What do I still own out of this? NVIDIA, Meta. If you're risk-loving, you'd still buy them. If you're risk-neutral, you'd buy into them. Tesla, I still own. Amazon, I still own. Not at the moment, but I'm sure it'll come back. ServiceNow, I don't have. Sterling or Medpace. Okay, so I've given you some names. There you go. People wanted them. Cash return on capital invested. This is from Goldman Sachs. Why I want that box ticked, because 30% per annum is what the basket of stocks generates, which generate that. We've had wonderful, wonderful reviews of my work over the years from these lovely people. Okay, and we're using AI more and more. Now, one of my students today, she said to me she got out of this prematurely. And I said, why? She goes, well, I've made a return 50% and I thought it's going to pull back. I said, you know, you can do, when you get that problem, the rule to use is if it drops X%, I'll sell Y. So if it drops 5, I'll sell 15%. If it drops 20, and you base Y on your risk appetite, okay? Because you don't know what the future holds, so you base it on your risk appetite. That was just in 2023. Now that has just gone mental. I didn't pick that. AI picked that. So, you know, I don't have opinions on stocks. The computer has it. AI picks. We're doing them for fun at the moment. All right, just so you know. Let me hit the beep. If I can improve your performance by 10% on 250,000 portfolio, that's 25K in 1 year. As you know, my ambition is to launch this as an antidote to the St. James's Place wealth management type. So take your money and then charge your fees. We want to do the exact opposite. You keep the money and not charge your fees. Okay. We do one-off and you get lifetime access to all of that. And I say this every time, so I won't bore you with it. We take 10 on at a time. When I get to about 350, we're at about 300 plus now. I'll look at getting some venture capital investment in and making it even more global. That's where you go. That's what we do. You keep hold of your capital. We don't want it, and we don't charge subscription fees, all the rest of it. That way I can be honest with you and tell you when to hold cash, because my fees are not dependent on me holding your capital. Okay, simple as that. Go there for all the freebies. I've got a load of questions also I want to answer from you guys as well. Where can I get a recording? Same link, alpeshpatel.com/latest shares. It'll be on give me about an hour after this. Yogesh public. Yogesh, Alpesh, this is a GIP went public. Yogesh, it's public. The private one is on the private Telegram channel. You don't need to watch this. It's on the private Telegram channel. Ravi, thank you. There you go. Oh, very kind of you. I am going to broadcast that comment to the room. You can speak to Ravi. He's online now, making the return on investment. Very impressive. Thank you very much, Ravi, my friend. We've got to meet up. Yeah, I know it's my fault. I've just been a bit swamped with Trump and everything else going on. Will you warn us when you're going to cash on the public? Yeah, Kishan. Well, I'll warn on the Telegram. Not Telegram, sorry. I'll tell you on the webinar. I do the webinars each week. So I'll tell you when I'm holding cash, if and when. Sana, what do you think about Apple with the new stock forecast downgrades? Do you think it's worth a buy now? What did I say about Apple earlier? I'm holding what I've got because of my exit's not hit. Would you buy now? If you're risk loving, you'd buy now. If you're risk averse, you wouldn't because it's overbought. And if you're risk neutral, you might add to winners. And the other rule I have is if in doubt, leave it out. Okay, so it's simple. There's your answer. Worst he can say is no. Yes, please, Alpesh. Haha. I was just going to ask for a speculative a speculative one. Oh, by the way, you go there. Let me give you oh yeah, Rigetti. Speculative non-GIP one. Quantum computing, Rigetti. Get ready for the wildest ride. You'll be up. A client of mine said he put 70 grand into Rigetti. He said I was up 73% in a month, and then I was down 20%. No, sorry, then I was down 40%, and then I'm up now 20%. And I said, bloody hell, you're giving me a heart attack reading about it. Okay, that's what I mean about volatility. So there's your speculative quantum computing hold. And it's the kind of one where if you force me to put a strategy to it, the strategy I'm going to tell you is just put money you can afford to lose and hold it until you make, honestly, I don't know. Just keep holding it until you make enough that you're happy. And if that time never happens, just keep holding it. It's like crypto. That's all I can say. There's your speculative one. Shell. I haven't looked at it recently. I guess drill baby drill should be fine. David, I use the stock exchanges for information. So we've got the various exchanges. Then we use the data providers as well, like Refinitiv, for instance. We used to use Bloomberg, but it's very expensive. So I don't use that anymore. Though I might come back to it. The thing is with Bloomberg is I then get addicted, and all I do is just swamp you with too much information as well. SoFi, not had a look. Question on finding undervalued stocks. I've been looking at PEG. PEG's all right, ideally in 1 year. It's okay, but you really need to look at not just undervaluation, because undervaluation could be because it's a rubbish company. You need to look at undervaluation combined with growth and a high Sortino, because all of that bookkeeping, accountancy stuff is fine. But if the stock price doesn't reflect it, then it's a waste of time. Okay. As well, has bitten me too many times. I know, Mark. Well, I told you, wanted a speculative one, also paid back. I'm in it today after avoiding it like the plague. I'm telling you, Mark, I take no responsibility for it. It's like crypto out there in quantum computing with Rigetti. It is a meme stock. It is a wild ride. It is you could be down 90%. All right. But you wanted a speculative one. Palantir is overbought. So if you are risk loving, you'd still get in. Okay. And you'd probably put a stop loss at, say, 20-25% under the entry price. If you are risk neutral, you might add to winners slowly. So you might put a small amount in. If you make a profit in a month or 2 weeks, you put more in. And if you're risk averse, you won't go near it because you're risk averse and it's overbought. Market's fun, though. It's not the kind of fun I like. Okay. SOF. I've not looked at SOFE. It does come up a lot, though. SOFE Technologies. Okay, I'll try and do a broadcast on it. A couple of people have mentioned it. NBIS, I've not had a look. Leave me some tickers and I'll try and do a separate video on all of that. Okay, but happy to answer questions offline. I take the questions off this, and then what I do is do videos separately as well if I've not had the chance to do it. I'm going to jump off. This is just to show you what our goals and ambitions are, and I think they're really good goals because I just think too many people are pissed off with how the banks are doing it. Do have a look at this, how the banks are doing it as well. I'm going to share more stuff with you. Okay, particularly on the IFAs, and some of the slides as well. That's a new thing. It's the first time I've done it on this webinar. They should be in the file box. You should be able to see them. Some of the slides are on there as well. Okay, let me see on the chat. Were there any other questions? IONQ. I will do those offline. I'm down to something United Health and the MSCI has fallen. Yes, I did a video on. Oh no, I did it to my private clients on United Health. It's the one where holding it hasn't any exits yet, so it's fine. So it's very simple. When you're holding something, has it hit your exits? No, then you're just waiting. Okay. If you haven't already bought it, you wouldn't, because the momentum's down at the moment and it's not a 7, 8, or 9. So simple as that. The classic example is Microsoft in 2021 went up 50%, but 9 of the 12 months it was down or sideways. So a lot of it is just waiting. A lot of people didn't make that return, even though the ones who got into it. There were 3 types of investors in Microsoft in 2021. Those who didn't invest at all, didn't make the 50%, and that's fine. Those who invested and then got out because they got bored or it went negative and they just couldn't wait, and those who made the full 50%, okay, or 45%, something like that in 2021. So that's what you got to watch out for. And the way you watch out for it is it daddy bear, mama bear, baby bear. Really simple. Do you sell covered calls? No, I don't. I haven't. I like to keep my life simple. As you've seen, I like to keep it really simple. How often do you buy a new stock? If it wasn't for the program, then it'd be roughly once a year. Sometimes more capital comes in and you might buy more during the course of a year. Because of the program, I try and do things more frequently so people don't feel like, well, he's bought something in January, or what about February, or what about March, and all of this. So I do mention it to my students, both what I hold and if I happen to buy something new anyway. Sometimes I just don't have the spare capital or the time actually to just go through with it. So I'll give you an example. I wouldn't have a problem with Oracle at the moment, but it's a risk-loving play because it's overbought and it's a volatile play. Okay, so it's the kind where getting it today is not the low of the year. Okay, so think about that. Today is not the low of the year for it. You mentioned last week's webinar, 4 out of 5 stop loss. 4 out of 5 hit the stop loss. No. 1 in 5, I think you mean. How many of those 4 out of 5 beat the S&P after a full year? I'm not sure what you mean 4 out of 5 hit stop loss. So out of 29 stocks in the video from last January, and remember that's filtered and narrowed down from, so the full list is 10,000 equities which are out there. We then bring that down to 200, and any of those 200 students pick, I have no issues with. We then do a filtered video, and that got narrowed down. It just so happened to 29. Okay, out of those 29, 5 hit their stop loss. So what is that? 1 in 6. Okay, the average return. Sorry, the spread was pretty good in terms of. What you're asking is, okay, out of the 41%, how many were above 41? How many were below? Was it an outlier? So if, in terms of what was the skewness or the kurtosis is what the statistician would ask. And it was a pretty good spread, actually. In an ideal world, none would have hit the spread, the stop loss, and all would have got exactly 40%. That's what you want in an ideal world. It doesn't happen like that. You get outliers to this side. So basically what you don't want to happen is one stock is responsible for your 41%. As you saw, that wasn't the case. There were a whole bunch which were above average. And I'd probably say about half of them were above the 40 and half were below, roughly. I did a video on that on TikTok and mentioned some of these stats. Thoughts on Nikesh Arora's golf game? Heard he was on form in California last week. Nikesh and I were on the board of TIE. He's CEO of Palo Alto. Nikesh does like golf. I think he really likes cricket. We used to go to Lord's a lot with his ex-wife. So he likes cricket. He also likes Post-its and the sort of management consultant view way of doing things. I haven't played golf with him because I don't play golf. So I couldn't say. But he's Palo Alto Networks has been doing incredibly well. And yeah, he's pushing it hard to do well. So I think incredible. Alpesh, just to understand, I have 3 stocks: BJ, Viper, and Live Nation. Where am I? They don't meet my criteria for reselection. However, momentum still looks good on all 3. So in this situation, hold the ideal option or to stick to the criteria problem. Difficult to say without looking at it. And if the momentum looks good, then you can just do it on that basis. What I sometimes do with some stocks, which I just want to hold for whatever reason. I've had cases where friends have floated companies and I got into it and thought, well, I'll hold into it. Sometimes it's been because of personal beliefs, like beyond me. God help me, what a stupid decision that was. And I just put that in a different category and say, well, this is based on this, and just put it in a separate tab. Once they hit stop loss, you sell. Generally, yeah. But imagine you didn't. These 5 equities beat the S&P over a year. So what happens is if they hit a stop loss, so 12 months, unless they're one of the quality 5, or it just take NVIDIA. Why have we had that since January 2023? Because A, it didn't hit any stops for us, but more importantly, as one of the quality 5 plus, it never did a daddy bear. More importantly, the momentum was just too strong and the gains were so great. Why would we exit? Okay, so it's a bit like that. It's not, but once you've hit this, so did those 5 equities beat the S&P over a year? Which 5 equities? No, the ones that hit the stop loss, I don't know. We didn't go back to look at them. Once we exit, we exit. Okay, there's a lot of hypotheses we could test, like other ones that we exited, did they then go up? There's a lot of things you can test for. We don't test for everything. We take one hypothesis, does it work? Yes, it does. That's it. We're not doing an infinite number of variations, because whenever we've tried to do an infinite number of variations, what happens? You just tie yourself in knots and you overthink it. And that's why we keep it simple. Again, Warren Buffett approach. You have one approach, one thing you look for, and that's it. Okay, we're not trying to be perfect. We're not trying to pick tops and bottoms. We're just trying to make enough money that we're happy with it. That's it. And not make any stupid mistakes. It's then a question of taking some profits, but keeping the original capital. Up to you whether you want to take profits or keep the original capital based on your risk appetite. At the end of it, you can either exit after 12 months. You can keep the result. The only problem with doing different strategies is you'll have a lot of stocks in your portfolio after a while, and it's going to get a bit of a mess. So generally, it's a lot cleaner just to get the hell out after 12 months. But like I said, I still own. You don't do that with the quality 5. That's the point of being in the quality 5, that they don't follow the other rules. And they're the rare companies, of which there are very few, which generally don't tend to fall that much. Thank you all very much. I am going to leave it at that. If there's any other questions, let me know on the chat, and I'll try and answer them offline on emails or videos or something else. So you can email me. Just go to alpeshpatel.com/links. As well, those who are on the program, who signed up on the program, I will send you onboarding materials afterwards, so you can get access to the data and to me as well. But for now, hopefully you found that all very useful. Thank you as well on all of that. Somebody's written in block capitals. Oh no, that one's gone. I've done that. Sorry. Thank you. All very good. Thanks all very much. More to follow, I am sure. Thanks everyone. Cheerio. Have a great evening. The chat, I think, will stay on for a bit longer, so don't worry, and I will read the chats, or alpeshpatel.com/links, and you can email me offline as well, no problems. Thank you all very much.